Welcome to the ETF.com video series. My name is Dave Nottig, Managing Director at ETF.com. I'm here at Inside ETFs with Ben Quah, Director of Capital Markets at Hartford Funds. Ben, thanks for joining us.
Thank you for having me.
So I think some people don't know Hartford is as big in the ETF space as they are. You have some real flagship funds like RODM, your $1.6 billion smart beta fund. Tell me a little bit about what's been working for you guys.
Yeah, I think, if you look at the market in the last couple of years, I think there's a larger adoption of what we call strategic beta ETFs these days. And I think that in line with a superior product, we believe, which is something that has outperformed other funds and other indexes, has come together nicely actually to propel our product. In 2018 alone, we've seen $1+ billion come into RODM specifically. So there's a number of factors, and those are the ones that have contributed to the success of the fund.
Yeah, and I think a lot of people have looked at some of the smart beta funds that haven't pulled in those assets, and they said, well, maybe smart beta is not so much of a thing. But like you said, $1 billion into an established strategy like RODM, hard to argue with.
Yeah, and I think performance matters.
Yeah.
And when you look at our funds, and we outperform the other funds, in addition to some of the other benefits that we bring from that fund perspective, it's all come together to help out.
Yeah, and performance, it's an interesting, you guys run a real estate fund, RORE, which has just been crushing it. I think it's been up 18% over the last 12 months, which is just obviously in the market we had in 2018, huge outperformance versus other alternatives, but it's a pretty small fund. I think it's $30 or $40 million. What do you say to advisors that are skeptical about smaller funds, even if they are outperforming like that?
It's the perfect question, because I'm part of capital markets, and one of the struggles that we have in capital markets and smaller funds is advisors are going to look and think, this is such a small fund. How do if I want to invest a large portion of money, how do I execute
trade it? Yeah.
Yeah, people look at the screens and they're like, there's not a lot of liquidity in this fund. So part of what I do best is to provide client that comfort to say, hey, don't worry, it's not trading very much, but the underlying liquidity is which is what we emphasize to clients. It's not what you see on screen. It's actually what the underlying assets, the basket, that matters. Right,
and something like RORE is trading widely liquid REITs. It's not trading unknown securities people aren't trading at all.
Correct. It's the US-based, US underlying, highly liquid ETF.
Right. So what are you guys working on in 2019? What are you talking about here at the conference? What's got you excited?
So again, we emphasize, our funds are strategic beta. So we emphasize what we call the space between, right? We have traditional cap-weighted ETFs. We have active mutual funds. The space between is strategic beta.
That's your sweet spot.
Yeah, that's our sweet spot. We keep talking about it. In addition to that, in addition to strategic beta, this year is going to be a big year for us where we concentrate on active fixed income. We work with our sub-advisors, Wellington and Schroders, and we have a couple of fixed income funds that we believe will also be good additions to the marketplace.
Yeah, I think a lot of people don't know that you do have that sort of suite of managers in there, and those are really well-known names in the active fixed income space. And people say, where's the active management in ETFs? You're bringing some of that.
Exactly, right. Exactly.
Ben, thanks so much for joining us. And thank you for joining us here at the ETF.com video series.